One of the most common conversations I have with retirees and pre retirees comes back to the same problem. How do I generate more income from my portfolio without spending my principal? It is a legitimate challenge, and today I want to walk through a strategy that has become an increasingly relevant answer to that question for a lot of investors. We are going to talk about structured income notes, what they are, how they work, and why some investors use them to potentially generate meaningful monthly income from stocks they already know. Before we get started, what you're seeing is an AI generated avatar of me, John Wiswell. The ideas, the research, the perspective, all real. We just think this is a great way to bring it to you. Let's walk through a real world example. This was an actual structured note available at the time I put this together. It was a 5-year structured income note issued by a major bank linked to 4 stocks: Nvidia, Tesla, Amazon, and JPMorgan. Before we get into the income, there is one structural feature worth understanding first. This note used what is called a lesser of structure. That means the performance of the note is determined by whichever of the 4 stocks performs the worst. Even if 3 stocks do exceptionally well and one underperforms, that weakest stock controls the outcome. That is not a flaw in the design. It is an opportunity to do your homework and make sure you choose notes that align with your risk appetite. Next, this note had a 5-year term, but was callable after the first 6 months. That means the bank could not redeem the note during the first 6 months. But after that point, the note could automatically redeem early on a monthly observation date if certain conditions were met. Now let's talk about the income, because this is what tends to get people's attention. This note was paying a 15% annual coupon with monthly payments. On a $100,000 investment, that works out to $15,000 per year, or roughly $1,250 every single month. For an investor trying to generate income without selling assets, that number changes the conversation immediately. Those coupon payments are contingent. You receive the monthly payment as long as the worst performing stock stays above a defined level called the coupon barrier. In this structure, the barrier was set at 60%. That means as long as the worst performing stock remained above 60% of its starting value, the investor kept receiving monthly income. A stock would have to fall more than 40% before the income stopped. Now, here's a feature that makes structured income notes particularly interesting: the memory coupon. In most investments, if you miss an income payment, it is gone. With a memory coupon, those missed payments accumulate. If a stock temporarily falls below the barrier, causing you to miss a payment, and then recovers above it, the note repays every missed coupon at once. So if Tesla dropped temporarily and you missed 3 monthly payments totaling roughly $3,750 and then recovered above the barrier, the following month you would receive the current payment plus all 3 missed payments together. Instead of $1,250 that month, you could receive $5,000 in a single payment. The income was deferred, not lost. Let's talk about the autocall feature. After the first 6 months, this note could automatically redeem early on any monthly observation date, but only if the worst performing stock was at or above 95% of its starting price on that date. If that condition was met, the bank could call the note, returning full principal to the investor along with all earned coupon payments, including any accumulated memory coupons. From the investor's perspective, that means generating high monthly income with the possibility of getting capital returned ahead of schedule, a clean and favorable exit. Now, let's address the risk clearly, because this is the part that matters most. This note had a 50% downside barrier at maturity. If the worst performing stock remained above 50% of its starting level at the end of the 5-year term, the investor received full principal back. A stock could be down 20, 30, or even 49%, and the principal was still protected. But if the worst performing stock fell below that 50% barrier at maturity, the protection disappeared and the investor was exposed to the full loss of that stock from its original starting price. In a lesser of structure, the only stock that ultimately matters is the weakest one, which is why understanding the underlying stocks and their individual risk profiles is a critical part of evaluating any note with this structure. That is the trade-off structured income notes ask you to make. You are accepting a very specific and clearly defined type of market risk in exchange for potentially enhanced monthly income and a different kind of portfolio behavior than traditional investments can offer. The risk is not hidden, the conditions are not vague. Everything is spelled out in the terms of the note before you commit. For investors who need their portfolio to generate income without selling assets, structured income notes open up a conversation that most traditional investment approaches simply cannot have. The income potential, the memory coupon feature, the defined protection level, and the possibility of an early autocall with full principal returned. Taken together, these are features that deserve a place in any serious retirement income discussion. As with everything we cover on this channel, the right question is never whether a product is good or bad in the abstract. It is whether the specific trade-off it offers matches the specific goal you are trying to achieve. And for a lot of retirees and pre-retirees working through the income problem, that answer is worth exploring carefully. Beyond the Ticker exists to be a resource you can trust. Subscribe, like this video, and if someone in your life could use this, send it their way. We are grateful for everyone who has found us. See you next time.